last thing that we want to talk about here is about something called market efficiency. And this is really about whether stocks, or asset prices, so stocks, bonds, commodities, whatever, are correctly valued or correctly priced, right? So we're talking about return, and return is a difference in price, right? It's the new price minus the old price divided by the new price, right? Or by the old price. Sorry. So how much are we gaining or losing over time? Right? And so part and parcel of talking about return is talking about whether prices are correct, right? How do we know that if I buy a share of Apple for $1,000, a share of Apple is actually worth $1,000? Right? Now, this has been the subject of a lot of research in finance and economics. Actually, a researcher won a Nobel for sort of defining this idea, and it's something that we call market efficiency. Right now, it's a little different than the way I was using efficiency earlier, which is I was using efficiency to talk about the ability of markets to match buyers and sellers. When we're talking about market efficiency, or when somebody is typically talking about a market efficiency, what they're talking about is whether assets are correctly priced in the market. Okay. And so in an efficient market, a market that has high efficiency, stocks are fairly priced, or assets are fairly priced, meaning they reflect the true value, right? And if this is true, then we shouldn't be able to earn any abnormal return. And all that means is more than the average return, right? We shouldn't be able to capture any true excess returns because the stocks are reflecting their correct prices, right? So on the other hand, if stocks were incorrectly priced, we would occasionally be able to observe that incorrect pricing and jump on that stock. Whether it was incorrectly priced one direction or another, we could short it if it was priced too high, or we could buy it if it was priced too low. And then when markets realized that incorrect price was there and they corrected, then we could capture that excess, that abnormal return. Right? And here's the thing, is that there are, by and large, anyone who is promising you that they can make more money than the average in the market is essentially claiming that markets aren't in any way efficient, that they are telling you they can observe some inefficiencies in markets and they're the only ones that can observe it, and because of that they can make more money than everybody else, right? Whatever. You will at some point in your life be confronted with any number of people promising you that they can do better than everybody else, right? And what we want to understand is that even possible, right? Is it possible that markets are in some way inefficient? They don't reflect the true value of the asset, and so that there does exist some potential for people to be able to capture more return than other people if they can be the one that observes this inefficiency, right? I'm going to go ahead and give you a hint and tell you that the answer is no. I mean, not really, right? Not with any true consistency, right? We may observe an inefficiency randomly and be the ones to capture that inefficiency, but we can't do it with any consistency. Okay? So, but it's important to remember that efficient markets, right? Saying a market is efficient doesn't mean that we can't earn a return. It just means that we can't earn any extra return, any abnormal return other than what everyone else does, right? We just want to say that we just want to make sure that we're clear on that. Okay, so here's what we mean by efficient markets. Okay, here's what we mean by efficient markets. Right, so imagine that the price of an asset, or let's just say a stock, the price of a stock is $140. Right? And it is $140, it is exactly correctly priced. So it reflects the true fundamental value of the company, right? This is one share of the company. $140 is reflective of the true fundamental value of one share in this company. And this graph is the price on the y-axis and the days relative to some positive announcement, some positive information about the value of the company, right? So starting 8 days before this positive announcement and going to 0, which is the day of the announcement, and then 8 days after the announcement. And so the announcement could be anything. It could be that we have a new product that's selling better than we expected, or a court case that was didn't look like it was going to go in our favor resolved in our favor, and so we ended up not having to pay a fine or whatever, right? Some positive announcement about the value of this firm occurs on day 0 in this graph. So the fundamental value is 140. After the positive announcement, the fundamental value jumps to 180, right? So we gain $40 in value because of whatever this positive news is. And in a truly perfectly efficient market, it would be this solid orange line. So the price would instantaneously adjust to fully reflect this new information. Right? So the market exactly correctly interprets the positive news and exactly correctly interprets how this positive news will affect the value of the company, and the price jumps to reflect that in an instant. Right? Now, the other potential outcomes are that this dotted yellow line is that there's some delayed reaction. It takes a while for the market to adjust to the new information. We hear the new information, we recognize that it looks positive, but it takes for a while for us to understand how this positive information is going to affect value. And so we see that this is a delayed adjustment from the fundamental price before the announcement and the fundamental price afterwards. Or we could have some overreaction where we jump way above what we think was going to happen because we over-adjusted to the new information. We thought, oh shit, this is going to be way better than we thought. And then we have to correct back down. But ultimately, regardless of whether we think markets are truly efficient or not, we see that the price corrects to the fundamental value efficiently. Right? So what we want to know is, right, in either of the other cases, so in the green dots or in the yellow dashes, there is some inefficiency in the market that could allow a person who observes those inefficiencies and correctly deduces that they are inefficiencies to trade on those inefficiencies and capture an excess return. Right? So I see that the market is having a delayed reaction to this positive news. I know that the true fundamental value is higher, so I buy it and then I make extra money while the rest of the market catches up to me. Or I see that the market has overreacted and I short it and I capture that extra value as I wait for the market to figure out what I already know. Right? So being able to capture these efficiencies is what we mean by saying you can earn an abnormal return. Right? Now, the question is are markets truly efficient? And I think at least another question that's really tied to that is, what actually makes markets efficient? Because the answer to are markets efficient is yes, by and large, we do think that markets are relatively efficient. In other words, we think that it is more likely that we see the solid orange line than that we see either the green or the yellow, right, with any consistency. And then if we want to know why, well, why is because the amount of participants in the market mean that new information is analyzed really quickly, right? There are tons and tons of people out there spending their entire lives, their whole job is looking at all this information that's coming out about public firms that they're invested in and then incorporating that into prices. And that makes its way into prices by their trades. So me and 1,000 other traders see this positive news about Amazon, and we all say, "Oh man, we look at how that's going to affect value. We have a big valuation spreadsheet. We plug in the new numbers. We see what it should be, and we make a trade that reflects that the prices should go up." And we all are going to have slightly different opinions on how that works out, but on average, we're going to approach the fundamental value. So we do think that prices do reflect public information, right? Is there scope for investors to capture some inefficiencies? Yes. But it's not with any consistency, right? So people don't beat the market over and over and over again. People beat it once and get lucky, or beat it twice and get lucky, and then do the same as everybody else. Now, the idea that markets are efficient and that no abnormal return can be captured is the result of something called the efficient market hypothesis, or the EMH, right? And this is sort of a fundamental guiding principle of most investing, right? And it comes in 3 different forms, right? So the first form is what we call strong form efficiency. And in a strong form market, we would say that all information, both public and private, is priced into stocks. So prices reflect the absolute ultimate amount of information. So public information that everybody knows, private information that only the CEO knows, and that no investor can capture any inefficiency because there isn't any efficiency to capture, right? But it doesn't necessarily say that there isn't some mistakes that could happen, right? We could know all information and still make a mistake about incorporating that information, and a lucky investor could capture some of that inefficiency. But all information is plugged in, right? Plugged into the model, even if maybe we as humans misinterpret the model and allow some inefficiencies to be captured, but with no consistency, no regularity, right? People can't do better than the average with any consistency. We don't think that's likely to be, I don't think that's likely to be the way that the markets are. Right? Semi-strong form efficiency is a little bit weaker. Semi-strong form efficiency says that all public information is incorporated, some private information is incorporated, and so the model has most of the right information in it, and that means that there are some inefficiencies to be captured either because we misinterpret the model or because we interpret the model correctly, but we're missing a key piece of information that, say, only the CEO knows about the company. Right? And so new information is correctly priced, it is correctly incorporated into prices, but there's still some scope for inefficiency. Again, there is no regularity at work. We cannot regularly, consistently find these anomalies, find these inefficiencies, and keep doing better than the average. Whereas the final form, the weakest form of the efficient market hypothesis, suggests that only past public information is priced into securities, and so no private information, new information takes some time to be incorporated. It's not immediate, and so there is some scope for really good investors to find these anomalies, find these inefficiencies, and potentially beat the market with some consistency. Now, in the long run, we don't think that investors can do it forever, but in the short run, they have some ability to continue to beat the market. Right? Now, the takeaway from all this is that efficient markets don't mean that you can't make money. Right? They don't mean that you can't earn a return. They do mean that you will earn the return that's appropriate for the level of risk that you take. So you're going to earn the average return, same as everybody else, for the level of risk that you take, same as everybody else. There isn't some exploitation available to you. You can't see this abnormality, you can't see this abnormal return, these inefficiencies, and capture them with consistency. Right? That doesn't mean that you can't make mistakes. It doesn't mean that you'll always correctly price the stock and that you'll always do exactly what everybody else does, right? If you make the wrong choices, market efficiency doesn't help you. If you make a mistake interpreting the information, the efficient market hypothesis doesn't save you. It just means that if you do everything correctly, then you will end up exactly where everyone else does. Okay, now the last few slides is just a simple example. Lets you calculate arithmetic mean, geometric mean, sample standard deviation. You don't really have to focus on any of this because we're going to do tons of this in chapter 13, right? So the way I want you to think about this chapter 12, is as the logical steps that are starting from, here's what we want, and what we want is to make a model that defines the relationship between risk and return, and we're talking through the logical steps of how we start to get there. In chapter 13, we'll take it even further, and we'll start to actually use numbers and create this model to get to where we're going. Okay, so don't forget, there's got homework for this chapter, and that's it.